A dividend champion is a company that's increased their dividend for at least 25 years in a row. Not just paid a dividend, increased it for at least 25 years in a row. Now, a dividend king is a company that's increased their dividend for at least 50 years in a row. And Walmart, a company that we've been invested in for a long time, happens to be a dividend king. They've been increasing their dividend since 1974. Truly a remarkable feat. Today's presentation, we're going to talk about dividend growth, international sales growth for Walmart, and what they've been up to in the world of technology. So recently, this was a couple months ago, Walmart raised their annual dividend 9%. So this is notable. It's the largest increase in a decade. All right, we're going to look at that. And as I said, this is the 51st consecutive year of dividend increases. So look at this table here. This shows Walmart's dividend increases over the past decade. And in the table, that's in gray. You see that for 10 years now, they've only been increasing their dividend by 2%. Prior to that, they had some rather sizable increases. Why is that? Well, it's because they've been making investments in their business. And one result of that is that Walmart, in our Quantigen's strategy, has fallen dramatically over the years in terms of their Q score. So this is very simple. We rank all dividend champions above a certain market cap cutoff. We rank them according to 7 factors. You see here, years, increasing dividend, market cap, yield, payout ratio. So look at Walmart right there. They're being penalized in 2 places for 5-year dividend growth and 10-year dividend growth. That's because those values are only 2%, and we want to invest in dividend growth companies that exceed inflation. So 2% is arguably not exceeding inflation at all. You also see here that Walmart has a small penalty on yield, so their yield is relatively low. But that's not all. Soon we're going to be penalizing them on international sales when we update this report. So their Q score is going to fall even further. So why are we invested in Walmart? Well, originally we selected them based on their high Q score, which, as I said, has fallen over the years. They're the largest retailer in the world, and they've been dabbling in technology a lot to create efficiencies. Now, that temporary slowing dividend growth, now it's been a decade, seems like that time flew by very fast. That time has been spent investing into the business, and this grand announcement of a dividend increase, a sizable dividend increase, may indicate a resumption of meaningful dividend growth. Now, the first question that you want to ask for any dividend champion is, what's the likelihood that they can not only pay their dividend, but keep increasing it over time? And I wanted to point you to something that's very interesting. So the table in the center here, this shows the operating cash flows for Walmart over the past 3 years. All right, they use a fiscal year, which is unfortunate, but they do. Free cash flow, that's what's left over after capital expenditures, after they reinvest into the business. So look at 2023 and 2024 capital expenditures. You see those in the table, $20.6 billion, $16.8 billion. Now that arrow points to the details of those values and what they're going into. So you can see that for 2024, they spent $11.8 billion in supply chain, customer-facing initiatives, and technology. So that's presumably going to yield rewards down the road. And then you can see store and club remodels, Walmart International. We're going to talk about that. So after they spent this last year $20.6 billion investing in their business, they had $15.1 billion left over that they could give back to shareholders. So what did they give to shareholders during 2024? Well, they gave back in 2 ways. In one way, of course, we know dividends, right? So you can see about $6 billion in dividends. So they could easily cover those dividend payments with their free cash flow. Then you can see share repurchases. Now, there's a couple things to note here. First of all, the table on the bottom shows these repurchases over time, and you see how they were close to $10 billion in 2022 and 2023. Then they dropped off a cliff in 2024. Coincidentally, as the company says, well, we're going to start increasing our dividend more than we have in the past. Although they have remaining share repurchases authorized of $16.5 billion, we still see this slowing down. And when we look at that at a quarterly basis, we can see quite a bit of volatility. And there's an obvious argument here around whether or not they should be buying back shares at all. So this chart here shows you the time frame of the previous chart, the quarterly buybacks, and you see that this is during a time where their share price was appreciating. Now, if you look at the research, you see it argued both ways. Of course, Buffett says that companies should only buy back shares when there's value to be had there, whilst McKinsey says there's no difference in value between share repurchases and dividend payments. They show you this table here. The argument for share repurchases is really a topic for another conversation. Some will say that it's simply executives trying to manipulate the share price because most of the time their bonuses are based on share price. But we're going to leave that conversation for a different day. Subscribe because we're going to be doing a video on that one of these days. So just to summarize, Walmart's ability to pay their dividends. So all I've done here on this table is plugged in that $15 billion in free cash flow. Let's say they were able to consistently maintain that going forward, right? And we see at the top there, their dividend now, they spent $6 billion on the dividend last year. That's now increased by what? 9%. So we plug that in, 6.54. Now you can see we've increased that dividend by 9% for 10 more years, or really 9 more years. Look at that. After 9 years, they're still able to cover that dividend, even though it's been increasing 9% for a decade. So that dividend that they're paying right now is covered easily with room to grow. All the capex that they're investing, that's going to show, presumably, results down the road to drive future growth. So it's reasonable, I think, to assume that meaningful dividend growth has resumed for Walmart, not just the 2% they've been paying out. Now, real quick, a public service announcement. We don't make these videos just because we like clout. We do this to sell products, and one of our products is the Quantigence dividend growth report that we've been citing in this presentation. Make sure you check that out. It's in our fourth wall store, and it's also available through a Nanalyze premium subscription. So the next topic, now that we've talked about Walmart's dividend safety and ability to grow, would be to look at international sales. The reason I want to talk about this is because they're going to be penalized because we recently updated our international sales data, and we penalize companies that don't have at least 20% of their sales coming from outside the United States. So for U.S.-based companies, at least multinationals, we want to see a nice geographic diversification of revenues. And here you can see Walmart is rather interesting. So they've been reducing their international footprint in recent years by divesting operations in Japan, Asda in the UK, Brazil, and Argentina. But they've been heavily focused on growing Mexico and also investing in India. So all of those out there who find India compelling would note that Walmart happens to be 80% owner in Flipkart, which commands 48% of India's e-commerce. So that's an interesting play there. But they, according to this article by TBP, expect to double international sales revenue from $100 billion around, that was in 2023, to $200 billion in the next 5 years. You can see in the table here how international sales are outpacing Walmart US and Sam's Club. So the growth of international sales above the 17.75% it sits today, if they're able to double international sales, then they'll probably have that penalty removed, which will help boost their Q score. And when we look at international sales here, we see that that growth is led by Flipkart, so that's their investment in India, Walmex, that's Walmart in Mexico, and China, interestingly enough. And they say here, we opened 110 new stores in the quarter, so that was the last quarter that they reported. Rather interesting to note that when you go down to their Walmart Mexico slide, what do they say here? They say they opened 162 stores in Mexico in the past 12 months, but 101 in the past quarter. So that would be what they said. They opened 110 total. So the vast majority, 101, were opened in Mexico. So they're really investing in Mexico. And you can see that when you look at the breakdown of their international revenues here. Mexico at around $13 billion. That's a 7.7% growth year over year. And then Canada at 6%. Not much growth happening there. And China at $4 billion with the most growth at 11.3%. Now, one thing to note here, you see this comparable sales growth for Walmart in Mexico. that's declining steadily over time. The same is true for the United States. So even if sales stay flat, and they're not expecting them to this coming year, they're guiding, I think, to a 3 to 4% increase in sales. Even if sales stay flat, technology can be used to bring down costs and increase earnings per share to help that dividend growth. And we've covered Walmart's foray into technology extensively over the years. These are just some of the articles looking at what Walmart is up to. And I wanted to point to this article by Axios, and it's really what we've noted. So you see here that this was during CES, they announced this generative AI-powered search. And you read through these list of things. This is their most recent dabbling in technology. You see that you can view a list of products across different categories. They can predict certain household items can be running low. Lets customers solicit feedback from friends about potential clothing purchases, a drone delivery program. This is reminiscent of these different technology themes that Walmart attaches itself to for a short period of time and then finds out it's just a fad and moves on to something else. The real meat behind Walmart's investments in technology is going to be automation, especially in warehouse automation. You see here, this is taken from Walmart. By the end of fiscal year 2026, so a couple years from now, they believe roughly 65% of their stores will be serviced by automation, and approximately 55% of the fulfillment center volume will move through automated facilities. This key point here, unit cost averages could improve by approximately 20%. That's huge, right? So if they can manage to have all those investments in technology show a return, then that's going to certainly help fuel dividend growth in the future. And one way to play this that investors might want to be aware of is a firm called Symbotic. Now, they have 88%. They do warehouse automation. 88% of 2023 revenues came from Walmart. So whenever you have customer concentration risk like that, it's not something we'd ever invest in, right? They would need to bring that way down. But it's rather interesting because we see that means that Walmart in 2023 spent over $1 billion on warehouse automation with Symbotic. And the other side note, you can read this article, go to our website, search for it, and read it. We've done other pieces on Symbotic. But in the last several years, they've managed to actually have gross margins above 15%, you can see there, and that seems to be where they're stabilizing at around 16, 17%. So not a lot of potential there. If you're selling hardware, then you want to look at recurring revenues. But the point here is that Walmart has been investing heavily in technology, and the real value for the company is going to be in supply chain efficiency. So the world's biggest grocer has lots of data to use, and they're in an excellent position to strong arm companies they work with into compliance. And I worked in a supply chain startup before, and we used to strong arm distributors into using our solution and say, well, McDonald's isn't going to buy your potatoes anymore unless you go and use this solution. So it's very effective when you're a big player to be able to force the people you work with to upgrade technology, and everybody in the supply chain will benefit from that. Now, the flip side to this is that Walmart's dabbling in every tech fad out there, and one can only hope they're cutting their losses when appropriate, and it seems to be the case. You can see this recent article by Payments. It talks about how Walmart's shutting down their innovation lab as retailers see tech bets eat into margins. So you need to canvas everything and then select the technologies that are going to show the most benefit. They seem to be doing that, and they don't seem hesitant to shut down ventures that aren't profitable. You see here they're going to shut all health clinics in the U.S. over lack of profitability. At the same time, they're also launching their own private brand. It says here, I think there's 300 products they plan to make available in stores. I don't buy sorts of pre-processed foods like this, but there's certainly some appeal to these, I suppose. We'll see how successful that is. So if you're interested in building your own dividend growth portfolio, I'm going to put up a video here that shows you how to do that. Please make sure to subscribe to our channel. Check out our Quantigence report, which walks you through our own 30 dividend growth stock portfolio. Thanks so much for taking the time to watch this today.